Will they keep rising in 2010, those commodities, or is this all a bubble about to burst? Let's ask Bank Julius Baer's Norbert Ruecker. He joins us now live from Zurich. A very good morning to you, sir. Norbert, will the commodity run continue, especially gold? Will it keep rising?
Well, I think it will definitely be a bit a different picture than 2009. There we have seen some clear drivers. First, the green shoots of recovery. We've seen US dollar weakness. And then we've also seen inflation fears that kind of really has been a rising tide for all commodity prices. For 2010, we still think that's it's going to be a positive year for commodities in general. Not as exciting as maybe 2009. But what really comes into focus is the single markets, really the fundamentals, the different market dynamics of the single commodities, and that's where actually investors really should focus on.
Specifically regarding gold, as you just heard, it was a safe haven bet. It was concerned about inflation, concerned about sovereign debt accumulating. What about this coming year? Moody's had pointed out last week that it will even be a problem for AAA rating countries, that sovereign debt pile. And then on the other hand, we had central banks, for example, India or also Mauritius or Sri Lanka or Russia buying lots of gold. How does that fit into the picture?
Well, it definitely has been a good year for gold, but for 2010 we are more or less neutral with our view on gold, and we still actually think that the insurance you get for investors against US dollar risk, against inflation risk, is quite costly with gold. And what you've seen in just before actually the crucial labor market report some weeks ago, you've really seen strong sentiment in gold prices, and still today. Actually, the positive momentum is still in there in gold prices. We still have record net long positions among commercial investors. So that should actually maybe in the next 3 months really offer some support to gold prices. But then in the longer term, it's really the investors, it's the physical demand from the investor side that is kind of one of the tipping points for gold prices, if they stay at these levels, if they go higher, or if they kind of drop to more their long-term average price levels.
And especially the link which you just mentioned to the US dollar, which has been improving over the last weeks or so, especially since the labor market report, as you said, dollar has gained significantly. Will that continue, or is it likely to decouple?
Well, we actually see a weaker dollar for 2010. So this really is one of our kind of supportive drivers for gold. But on the other hand, it has really also been the real rates, so the interest rate levels and the inflation's expectations that really offered support for gold. I mean, it's basically the opportunity cost of holding gold have been really low, and that also propelled prices. And heading into 2010, we actually think that the inflation expectation we see in the market, they are quite adequate, and we also do not expect much tightening for 2010 for the interest rate cycle. So there's really, in our view, not much additional support from this side. On the other hand, I mean, you also mentioned the central bank buying. It has been basically India, and this has to be kind of weighted against what the producers have actually been buying in physical gold over the past years, which has been a really important driver. And on the other hand, investor demand in 2009, physical investor demand from all those products, physical backed ETFs out there in the market, they really jumped in and offset the weak jewelry demand. The jewelry consumption really declined a lot because of these high prices. So for 2010, I think it's really a call. What are investors going to do? Are they continuing buying physical gold through ETFs?
Yeah.
And can they then kind of offset the weak market balance?
Thank you so much, Norbert Ruecker there from Bank Julius Baer. Now